Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Alternative assets have become very popular as the benefits they bring to investment portfolios are more widely known and the accessibility has increased. I have an industry expert on to share his insights into the world of alternatives and the different types. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome Andrew Krei. Andrew is a co-CIO of Crescent Grove Advisors and Barrett Upton Capital Partners. Andrew, thank you so much for coming on the show. Like I said, it's a real honor to have you on. I appreciate it. Can you please tell us a little bit more about yourself, Crescent Grove Advisors, and why you launched Barrett Upton Capital Partners?
Yeah, first off, great to be here. Thanks for having me, Ryan. Looking forward to this conversation. So Crescent Grove Advisors, we're a little over $4.5 billion RIA, principally focused on high and ultra high net worth individuals and families, and sort of a multifamily office type of product offering or service delivery model. We also work with some endowments and foundations. But if you think about what we do, like I said, multifamily office in the sense that it's this multidisciplinary approach that we bring to working with clients. So investments, of course, big piece of what we do. That's how I really spend my time as co-CIO, our bread and butter, in the sense of managing client assets. But then alongside it, it's tax prep, it's comp and benefits analysis, it's trust and estates, it's insurance analysis, it's philanthropic guidance. It's all those sort of ancillary services that we think give us a unique kind of offering in the marketplace, because ultimately what we want to try to do is make good decisions in any one of those disciplines and then compound that across multiple disciplines, right? So you can make a great decision in the investment side that will impact the tax side, the trust and estate side, and so forth. So that's how we kind of think about our secret sauce alongside what we do on the investment side. And to that point, and to that end, your question about Barrett Upton Capital Partners. So we stood up an affiliate RIA last year that was really designed to help us provide differentiated, unique access to private market opportunities, principally alternative investments across kind of a range of different asset classes: private equity, private real estate, private credit, hedge funds, you name it, under that big umbrella of alternative investments. And what we had found through the years, and we've been investing in alternatives now for well over a decade as a group, is that they're just areas that are difficult to access without some sort of vehicle to have dedicated capital and capacity to go into, to speak for a high minimum, let's say, to have the ability to write a single check into a manager, to be able to kind of aggregate client assets. And then you think about the logistics around building out a program with an alternatives, meaning a diversified set of alternative offerings in a client portfolio. How can you consolidate K1s, go from 5 K1s to 1 K1? How can you consolidate line items in a statement and sort of streamline reporting, right? So that was really our thought around building this platform. Was it gave us a lot of capabilities that we wouldn't have otherwise had.
Interesting. That's awesome. So with Crescent Grove, when you were talking, it's really a true holistic advisory firm that, a client, investor can feel comfortable knowing that they have a holistic approach to their investments, to their financial plan, and so on. And with Barrett, was there just so much interest in private equity or private markets alternatives that you were like, and there's such a hole in that space, like you said, where yes, accessibility is getting easier, but still not completely there for a retail investor?
Yeah, I think that's just it, right? And especially in the types of opportunities where we want to play and be really effective. And take private equity as a great example of this, and sort of subcategories therein. Think about venture capital, highly capacity constrained asset class. You've got managers, really the top tier managers that have shown persistence of performance over time. A lot of times they're oversubscribed. They might only give you a sliver of capacity. So for us, it's trying to solve for, how can we offer this to our client base, get our clients invested in what we think are top tier sponsors, really attractive opportunities within private markets, but solve some of those issues, around access, around capacity, around minimums, et cetera. And we feel like this is sort of an elegant way to put this together and then again deliver this to clients in a way that logistically, operationally makes a lot of sense as well.
Fantastic. You mentioned private equity, and it's arguably the most popular or sought after type of alternative. What is your approach to private equity?
Well, so if we step back and kind of think about the taxonomy of private equity, in our view, we break it down a couple different ways, or a couple different along a few different lines. Let's say so. Venture capital would kind of be the more risky, earlier stage end of the spectrum. And let's take that as sort of Series Seed or A or B. Growth equity is another way we kind of look at the private equity, the big 10 of private equity. That segment we kind of think of as Series C and later. And then we'll look at buyouts, which are going to be much more mature companies, generally going to be more control positions. And then the fourth bucket that we look at is sort of an opportunistic bucket, let's call it, which will comprise or be comprised of secondaries and co-investment. Is sort of generally speaking what's going to land in there. There might be a few other unique things that pop up along the way, but that's sort of the broad approach to how we segment the private equity universe. And then, I talked about kind of this idea of a programmatic approach to investing within private markets. Well, within private equity, our approach through and through is diversification, and that happens across those underlying sub asset classes, if you want to call them that, within private equity. It happens across sponsor. So we don't want to concentrate just in a single sponsor, single GP doing deals. We want to have diversification on that front. And then we want to have vintage year diversification.
Okay.
Right. So we don't want to just sort of, take a rifle shot approach in any one year where we're then sort of subject to the market conditions that, when the money's going to the ground, and then subsequently 5, 7, 8 years later, when you're in harvest mode, what do the market conditions look like that at that point in time? Right. We want to have a little more of an even paced, spread out approach over time across all those sort of different, sort of vectors of how we put together a private equity program. So that's kind of the big picture way that we think about the world in that case.
Andrew, I'm glad you really brought that up, because to me, and hopefully others, it's not just me that think, private equity is just private equity, right? It's broad. And it, as you were talking, it kind of reminded me of like fixed income, right? Yes, there's fixed income, but there's so many different sectors and different types of fixed income that wraps up in the fixed income. I got the sense hearing you talk there is that private equity is similar. We might know about VC and secondaries, but there's so many different sleeves to private equity. So that to me must be difficult for financial advisors to consider when choosing, where do I go, what sleeve, or do I just invest in private equity in general? How should financial advisors consider those different sleeves when building an investment portfolio for their clients?
Yeah, I think that's a great point, is that there's just so much nuance to the different segments within this broad moniker of private equity. And I think you're totally right. People have this view, generally speaking, probably of private equity is just buyouts, mega cap buyouts, kind of the household names that you might think of within the mega cap buyout space. But there's so much more out there, so much more diversity, so much more that you can sort of levers you can pull from a risk and return perspective, whether that's earlier stage, later stage. There are things you can kind of think about, as you alluded to, as secondaries, where you get money out the door perhaps more quickly. It's a shorter duration asset relative to people think about venture capital tends to be 12, 15 years, right? So you take all that into account, and I think from our perspective, there's just a lot of complexities to navigate. And so for somebody new to the space, a financial advisor new to the space, I think a big sort of recommendation that we would make is find a trusted intermediary there. Find somebody who can help you understand from an educational perspective what's out there, kind of the product offerings, the product types, get a good feel and understanding for what market terms are, fees. If there's some sort of liquidity feature, they're now sort of a movement towards more semi-liquid or evergreen structures within private equity, or otherwise, if you're in a committed capital vehicle, really understand what you're signing up for from that perspective. And then I think the other piece of it too is just the practical side. I alluded to it earlier, but what are the logistics? Dealing with subscription agreements, dealing with how do I get this, kind of booked in the client account? What's reporting going to look like? What's tax compliance and reporting going to look like? So there's just all these different elements at play here that you don't have when you're investing in a traditional 40 Act mutual fund, let's say, that I think you have to have a trusted third party generally helping you out if you're really new to the space.
Fantastic. Yeah, that's one. It's like a doctor or mechanic. I don't really know anything about cars, so I'm going to pay the money to have a mechanic do what I need on my car. And like you said, but I also, what you talked about is make sure you understand what you're investing in. You can say that about, 40 Act funds too, or ETFs. You got to understand what you are investing in. It's arguably, or what you offer your clients. Right. And talking about that, what type of investment vehicles are available for these alternative or private equity? Is it limited partnerships? Is it, what type of vehicles can you access alternatives through, or private equity for the most part?
Yeah, traditionally it's been almost entirely limited partnerships, and particularly within venture capital, growth equity, private equity, you've just seen this idea of you make a commitment, of a certain amount, that the capital, your commitment's going to be drawn down over the period of 3-4 years, let's say. Then there's going to be some harvest period, and most of these funds are going to be 10, 12, 15 years life. There's no liquidity option, notwithstanding some secondary kind of sales, which we can talk about in a minute. But I think there's been this push to try to get private equity into at least more of a semi-liquid type of vehicle, especially by some of the bigger players in the private equity space, just to make this a little bit more accessible for the broader wealth channel to be able to access and feel a little bit more familiar, relative to maybe like an interval fund structure or something along those lines, right? I think that will be an ongoing push, and there will be more mechanisms in place with secondary markets as that becomes more robust and we get more liquidity and more volume, more transparency on secondary transactions in private markets. But we're still really of the opinion that this is a sort of committed capital type of asset class. The limited partnership structure has been in place for a long time for a good reason, and that's generally our preference in terms of how we access these types of funds and managers.
And it works, right? There's a reason why it's been around for years. You talked about, as a financial advisor, leveraging experts or people that really know this space. What type of questions would a financial advisor ask, when they're conducting a due diligence on private equity managers or limited partnerships? What are some things they should consider?
Sure. So I would say, starting as a baseline, it's going back to this idea of understanding the terms of the structure that you're looking at, you're investing in. So, is there any liquidity? In the case of a semi-liquid structure, what are the terms around that? Do they have a sort of a tender offer period, et cetera, et cetera? But also, kind of digging in around management fees, around incentive fees. Is there a preferred return? All these elements, that you can kind of assess and look: is this market? Is this above market, below market? On and on and on. And then I think, some of the more unique characteristics of private markets deals, you're starting to dig into things like key person risk. Is there some recourse as an investor if one of the key people at this firm leaves, that's controlling the investment activity? So that's, I think, a really big piece of the puzzle to understand. And again, because you're making, generally speaking, a long-term commitment here, as opposed to a liquid ETF mutual fund type option where you can just opt to sell any given day and pull your money out if you don't like what's happening. You really got to understand that on the front end. Now, beyond that, as it relates to kind of the merits of the strategy, the firm, the team, it's a lot of the same sort of questions you'd ask in a traditional sense. But the one area I think that's a bit more unique within private markets is really understanding sourcing and access, right? So it's not like just going out to the public marketplace and you find any given stock and you can trade it, right? A lot of these deals are sourced on a proprietary basis, or they may be through some auction process. But how is this firm? What's their right to win? How are they going to get the very best deals? And a lot of times that comes back to the quality of the team and the personnel. It comes back to their track record. Do they have a track record of success, which has generated sort of a halo effect where people want to work with them, companies want to work with them, founders want to work with them, in the case of a venture capital firm. And I think another element at play that we like to really look at as a differentiator is what sort of operational capabilities does a firm bring to bear? And not just from a financial engineering perspective, but do they have almost a consulting type of DNA where they could go into their portfolio companies, help them improve profitability, improve, sort of throughput on some sort of fulfillment process, if they're in the consumer space or manufacturing space, all these sorts of levers that a private equity or growth equity venture capital firm can then pull to help drive value creation above and beyond just buying low and selling high, right? So those are a handful of things that we're looking at. There's obviously layers of complexity to all those, but certainly sort of the ante for us to want to understand all those things going into a deal.
Interesting. So at Zephyr, we have the PSN SMA database, which is the longest running database of separately managed accounts. And we often talk very similar in terms of when you're looking for a separately managed account manager, it's more important to look on the qualitative side about, operational due diligence, looking at the corporation, the structure, like you say, personnel risk, what is that makeup? And it's interesting that it's really the same thing on the private equity side too. It's the same type of question. You're more worried about, what's going on behind the scenes at, the corporation and personnel than you are returns and risk in a way.
Without a doubt, right? And again, I go back to the idea that these are long-term commitments you're making. So you have to have some level of confidence in the stability of the firm, the quality of the leadership team, and then the quality of the bench behind them in the event something happens to one of the key folks in the senior management team, the senior sort of partner team, right? So that's a huge piece of the evaluation as we're looking at these different deals.
Fantastic. Let's get a little bit more granular and talk about the different alternative assets. And looking forward, what alternative assets do you find attractive and offer the greatest opportunities moving forward?
So we think private equity right now, under again the sort of broad umbrella of private equity, looks really interesting, and it's a function of a couple different things. I mean, first and foremost, we had this big reset in 2022 where rates moved higher, right? And we saw valuations reset for some of the growthy areas of public markets, and we started to see some of that flow through into private markets as well. Venture capital down rounds. I think we're up significantly last year. We've just seen this broad reset in valuations kind of writ large in private markets. Again, sort of akin to what we saw in public markets. Now, historically, when that happens, and you look back at vintages that were raised during or immediately after those types of periods, sort of that would be analogous to what we saw in 2022 and into 23 in some cases, those tend to be your best vintages. So we think, as capital formation slowed down, fundraising, anecdotally and in the actual data that now that we're seeing, which always comes on a lag, of course, but we're seeing real data to suggest that fundraising was slow, was very sluggish. Funds just weren't getting raised at the same rate that they were certainly going back to 2021. All that we think points to a pretty good environment to deploy capital into these types of private deals within private equity over the next 12 to 24 months. And it's impossible to market time this, so don't bother on that front either, right? You want to be directionally correct, not sort of precisely correct here. It's that I think is impossible. And then the other piece of it that I think is sort of tangential is secondaries, and that ties into the lack of exits that we saw for a lot of the same reasons I just discussed about it was more difficult for funds to raise money. The IPO market was more or less shut, so you saw a lack of distributions over a 18 to 24 month period. And you had a lot of investors in these funds that date back to 2013, 2015, 2016, et cetera, that were looking to get some liquidity. So secondaries start to become a pretty interesting avenue for investors to either offload pieces of their portfolio to secondary buyers. And these secondary buyers are often buying at a discount to where the last mark was, which is an attractive way to get exposure to kind of mature assets in private markets. There's this sort of advent of GP-led secondaries, which is a manager that owns a trophy asset, let's say that's late in its fund life, that then raises what they call a continuation vehicle. They want to keep owning this asset, but they want to be able to offer the investors in that fund some liquidity mechanism. Well, now there are sort of ways that they can transact around, again, providing liquidity, but also continuing to own this asset through these GP-led secondaries vehicles. So all told, we think secondaries is a pretty interesting part of the market as well. And part, we would argue part of a broader private equity strategy that an investor would put together.
Great. You mentioned rates. It's hard in this environment, investments, to not bring up rates. The Fed who knows when, but chances are they're going to cut rates at some point at the end of this year, maybe beginning of 2025. How does that impact private equity? I would think it would be more of a tailwind, make it capital raising cheaper and so on. But what's your thoughts on, interest rates and how that impacts the industry?
Yeah, well, certainly on the buyout side, where there tends to be more leverage in the deals. If you go back to, kind of pre-Fed hiking cycle, you go back to the 2010s, really, let's just say broadly speaking, where cost of capital was ultra low. That made those deals really attractive, just in terms of the cost of leverage being so low. You could kind of financially engineer your way to a good outcome. Now, I think now that the cost of capital is higher, and certainly I think the barriers to borrowing are a little bit higher as well, as lenders have tightened their standards to lend into that marketplace, to lend to private equity sponsors to do deals. I think it's just sort of raised the bar in terms of the types of deals that will ultimately get done now, which probably leads to a little bit more quality. But all things equal, it's a little bit more difficult to get deals done in this environment for your traditional buyout shop. Now, for venture capital, growth equity, those deals tend to be unlevered. It's really more of a valuation story. It's kind of the discount rate. If you're thinking about a discounted cash flow type model, if your discount rate is zero, you're going to pay crazy times, earnings or lack of earnings in some cases, sales, let's say top line. But when your discount rate moves higher and you have a little bit more of a demanding valuation environment, that's, I think, the result that we saw post 2022, that reset period. Now we're starting to see more down rounds and sort of a rationalization of multiples. Right. So I think it's kind of a few different factors at play here, but hopefully that helps frame it up.
That's fantastic. Thank you. It's just, I often talk about, hopefully soon we get in a period of normalization, right? We've had just all this chaos from the pandemic and, the highest spike in interest rates on record and 40-year inflation. Hopefully now we get some normalization across the board and whatever normal is, right?
That's right.
Why are more RIs looking for alternatives? And do you look for this trend to continue?
Yeah, I think it's a function of, just historically speaking, you look at this illiquidity premium that's on offer within private equity. Again, broadly speaking, there's an attraction to things that offer higher rates of return, even if it comes with a little bit of illiquidity, right? So I think that's been a driving force why RIAs, why the private wealth channel wants to get into private equity. And then on the other side of the coin, if you look at, maybe sort of risk mitigation type strategies within alternatives like hedge funds, other areas of the alternatives market, even real estate to some extent, core real estate maybe has served a little bit more of a ballast in client portfolios, income generative type assets. I think it's the combination of those things that have been really attractive in the private wealth market. And I think going back to the point too that we were discussing earlier about this idea that asset managers want to cater to that market. They want to offer more educational materials. They want to offer more vehicles that streamline the subscription process, the ongoing monitoring process, liquidity features and so forth. Yeah, I don't think there's any end in sight to that trend. So, I do think that's where we'll continue to head. And I think the adoption will continue to be there. The demand's certainly there from the private wealth channel.
Fantastic, Andrew. Such a interesting conversation. I learned a lot. I think our audience is going to learn a lot too. There's just so much to alternatives and private equity. I'd love to have you on again to talk maybe more about the specifics and get maybe a little bit more in the weeds. I'd like to finish the conversation with something fun. At the beginning of this show, when we were just chatting, we talked about you are in Milwaukee. As most people know, I'm from Wisconsin, way north compared to where Milwaukee is. But that first thing I thought of when you said you're in Milwaukee is Marquette. As a Badger fan, we don't tend to like Marquette. What's your take on the whole Marquette Badger rivalry?
Well, I am a transplant in full disclosure. I'm not from here originally, but my wife went to Marquette Law School.
Okay.
And it's a hot and heavy rivalry, that's for sure. And I see a lot of stuff, I'm on a lot of group texts with, sort of mixed company, the Marquette group, the Badger group, and people, they really get after it. They go back and forth. But I've kind of become an equal opportunity Wisconsin sports lover. So I try not to take too much of a side on any of this, but it's an awesome state. Love Milwaukee. It's a coiled spring come summertime, which everybody's looking forward to now as the weather improves. And I would just encourage anybody to come visit Milwaukee in the summer. You're going to have a great time. It's beautiful right by the lake. But it's a fun city. It's a fun place to be.
Great. I've never really spent a whole lot of time in Milwaukee. Like I said, I was born and raised way north, and it has, from my understanding, I know people that live there, it's really improved and cleaned up and is getting to be a great city to visit. And I agree, in Wisconsin, even here in Lake Tahoe, come spring and the sun is out and we're getting 60, there's nothing better. And there's just that excitement in the air. It's nice.
No doubt. Yeah, you're hibernating in Wisconsin for 6 months, so you're ready to go, come April and May.
I don't know. Maybe you're a transplant there. I don't know if you've taken up ice fishing yet or not, but it's great.
I haven't, but I'll put that on the list. I got a lot of winter things on the list, but yeah, we'll get down there. We'll get some ice fishing eventually.
There you go. Thank you so much, Andrew. One last thing. Thank you so much for coming on the show. It was, like I said, an honor and privilege to have you on. Where can the audience get more information about Barrett Upton Capital Partners and Crescent Grove Advisors?
Yeah, well, thanks for having me on, Ryan. This was great. Enjoyed the discussion. Yeah, if you go to either barrettuptoncapitalpartners.com or crescentgroveadvisors.com, okay. Both our websites, we publish sort of insights and media, anything we're doing on an ongoing basis. And then LinkedIn is a great way to find me, to find my colleagues, and both entities. So you can follow us there, where we publish again on an ongoing basis.
Fantastic. I will include links to those, to your websites, in our show notes, so our audience can find those. Thank you again, Andrew, for the great conversation. And thank you for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, iHeartRadio, and Spotify. Thank you very much, and have a great rest of your week.